You're a physician practice owner. You picked a PLLC when you started, probably because your colleague told you to, and you've never revisited that decision. Here's the problem. If your practice is clearing more than $150,000 in net income, your entity choice might be costing you 5 figures every year in avoidable tax. Let's break down the two most common structures. First, the PLLC on its own, a professional limited liability company. By default, it's taxed as a sole proprietorship or partnership. All your practice profit flows through to your personal return on Schedule C or as a K-1, the income statement partners receive. You pay full self-employment tax, that's 15.3% on top of your regular income tax, on every dollar of net profit. Now, option 2, you keep the PLLC for liability protection, but you file an S-Corp election on top of it. Under S-Corp rules, you pay yourself a reasonable salary via W-2, and you take the rest of the profit as distributions. Those distributions are not subject to self-employment tax. At higher income levels, the recurring savings are real. The break-even is usually somewhere between $100,000 and $150,000 in net practice income. Below that, the S-Corp savings don't justify the added complexity. Above it, the math starts to work in your favor. The catch: S-Corp election requires actual payroll, quarterly 941s, W-2s at year-end, and documented reasonable compensation. The IRS audits physician S-Corp owner comp regularly, so your salary has to be defensible. If you're above the break-even and still running PLC default, you may be leaving meaningful money on the table every single year. Worth a 30-minute conversation. Links in the description below. Thanks for watching. We're here when you're ready.